Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. I will cover my market insights here, an update on the charts and the dashboard. And today is July 5th, 2023. I did not do a video on economics in the market and my thoughts there, but so I will cover this, and this will be my video for the week. But again, I think it's interesting about where things are going, and so I'll try to lay that out for you. Okay, we'll begin with the dashboard, and these are the 6 U.S. indexes. Excuse me, I'm sorry. There are 4 U.S. indexes, 2 international indexes, and the long-term government bond. So this gives us a really good comprehensive view of the market. Last week, equities, the 4 U.S. and 2 foreign equity indexes, were positive. And of course, they are positive year to date. So you can see in the yellow box going down the list, those are the results. So everything is positive except the bonds were slightly negative for the week. The pink box covers the year to date. Everything is positive year to date. Very different picture than last year. So they are in descending order from best performer to worst performer in the pink box. So you can see the top performers are the NASDAQ 100, driven heavily by tech, and the S&P 500, which includes tech in it. Then you drop down to the foreign markets, the developed countries, at a gain of 10%, and it starts to drop off. After that, small cap has had a gain of 7%, and then emerging markets, Dow Industrials, and of course, bonds at the bottom. On the right, the far right, you see the dots indicating are they above or below their moving averages, 20, 50, 100, and 200-day moving averages from left to right. So other than bonds, nearly everything is positive and above its moving averages. This is a positive indicator for the market, at least through last Friday. Now, well, I'll get into the S&P in just a minute. This is a breakdown of the S&P into the, again, yellow box is last week. The pink box is year to date. Last week, everything was positive. And the 2 most positive were, as you go down that list, let's see, it's 6th, is real estate investment trust, positive over 5%. Telecommunication, positive over 5%. And then they drop down. The worst was healthcare and consumer staples. They've been, bringing up the rear quite a bit this year, and but yet they were the leaders last year. I mean, right behind energy, it was consumer staples and healthcare. So those 2 are slightly positive for the week. When you get to the year to date, you have 2 primary sectors that are positive: technology and consumer discretionary, both above 30%. Then you drop way down into 4 different sectors that are positive, and then you have 5 sectors that are negative for the year, negative year to date. So the S&P 500 is made up of these huge winners, those somewhere in the middle, and losers. And that's not uncommon. The S&P can have wide divergences from winners to losers. We saw the same thing last year, except the roles were reversed. We could almost take this chart and turn it upside down, and that would be last year. It was a very different picture. This year, this is the last 18 months, so going back to mid-March of last year, we see that the S&P 500 came down a lot and then has surged up from its low in October to today. Now, I have to say this because it's an opinion. I believe that the S&P 500 is indefinitely in overbought territory. This is, in my opinion, not a time to add new money or to bring money into the market. It has, in my opinion, more downside risk than upside opportunity with the overextended position that it had as of last Friday. I drew the line, the black line, so you could see the direction. Is it going to go up? It could go up. But when you see the up and down part of the market, I would say the chances are it's going to have a correction before it continues on up, because it's just for the underlying values of the market and the fact that a number of sectors are actually down for the year tells me that there is more downside risk than there is upside opportunity, at least at this point. The S&P 500 is broken into two components: growth stocks and value stocks. Growth stocks are represented by the ETF SPY-G, and the value stocks are represented by the ETF SPY-V. And I put these in a relative value chart to show you, with SPY-G being the numerator, SPY-V being the denominator. If it goes up, this favors growth, SPY-G. If it goes down, it favors value, SPY-V. And you can see from the black line that I drew at the end of the chart, from the beginning of January to today, it has definitely favored growth. Growth is in favor, measured for a period of 6 months. However, when you look at the very end, you see that it tipped down a little bit. That is favoring value. So last week, value was more in favor than growth. On a relative value chart, I contrast also large cap stocks or indexes compared to small cap. Large cap is the S&P 500, the 500 largest companies, publicly traded companies, and that's SPY. And denominator, IWM, which is the small cap index. So when it goes up, this favors large cap. When it comes down, it favors small cap. So you can see that larger companies have done better, represented by the black arrow, since about March of this year, a lot better than small cap. However, at the very end, you see that tick down, and that represents that last week, that small cap did better than large cap. Prior to March of last year, you can see it mostly just went up and down a lot, not really moving at one time favoring one, at one time favoring the other, but not in a particular trend or direction. Long-term government bond, I'm going to go away from relative value charts to an absolute chart. So you can see the long-term government bond represented by the ETF TLT. This is an 18-month chart. And you can see from actually sometime in November to present that there has been a slight decline in bonds in this ETF. The intermediate term bond and the short term bond are similar. They're different, but they're generally speaking similar. And so you can see that the, more than anything, I mean, it's down a little bit, but mostly you can see it's just sideways. It's going nowhere. It's not going down or up, really. So what it's doing in balanced portfolios, 60-40 buy and hold portfolios, what it's doing is putting an anchor or a weight on the uptrend of the market. So portfolios that are allocated in a 60-40 format are being held back by the bond component of that portfolio. This being a representation of bonds, but it's not the only one. It's just the long-term bond. But you can definitely see that bonds are holding back equity advances in a buy and hold portfolio. The US dollar continues to be in a downward decline. It went down a lot, and you can see it's gone up and down since January. But generally speaking, I'd say since last October, you can see that the dollar is going down. Prior to that time, it was definitely surging above other currencies. Gold, since October of last year, has been generally speaking in an upward trend. However, for the last couple of months, you can see that it has been in a little bit of a short-term downtrend and is now below its 20-period moving average. But it's, I'd say the general trend is up when you look at it, at least over that period of time. Silver, the same thing, except silver is more volatile than gold. So it has been, generally speaking, up, and it actually experienced a positive week last week, and you can see that by the little tick up at the very end on the far right. And but short term, it's been down, moving down a little bit, and it's below its 20-period moving average. But over the last 8 or 9 months, you can definitely see that it's in an upward trend. Silver versus gold. So again, this is a relative value chart showing silver as the numerator, gold as the denominator, and when it moves up, this favors silver. When it moves down, it favors gold. I did not put an arrow on this chart, and the reason is because there is no definitive direction. It goes up a lot and down a lot. So you can look at whatever version you want, but I would say in the middle of the chart, you see this huge downtrend of silver. It went down for that period of time, and then it surged up, and then it's been going sideways or down since that period of time. But it's not silver and it's not gold. It's the relative strength of silver versus gold. So at this point, I don't think it necessarily favors silver, and I don't necessarily think it favors gold. Bitcoin has done very well since the beginning of the year, and our Bitcoin model has done very well, our managed crypto model, and we use BITO as our exchange traded fund for Bitcoin, and it's up quite a bit. It's up over 40% for the year, and this is up even more. So, but we try to avoid a lot of the downside risk in our investing strategy, but this shows that basically Bitcoin is moving up in the last 6 months, generally speaking, in an upward direction. But you can see prior to 2023, 2022 was a horrible year. Bitcoin lost and crypto lost, Bitcoin in particular, lost about 75% of its value. That's why in our invested approach, we take a managed approach to it, trying to capture as much of the upside as we can and avoid as much of the downside as we can. We know we're going to give up a little bit of that upside, and we're also not going to completely avoid all of the risk on the downside. But if we can capture 80% of the upside and avoid 80% of the downside, I'm definitely happy with that. Okay, volatility index. The volatility, meaning that if it goes up, there's higher volatility in the market. If it goes down, there's lower volatility. So if the market is going up, generally speaking, this is coming down, although that is not always true, and vice versa. So you can see that from the standpoint of the volatility index, that the market is showing a period of stability. Now, when it's that low and it's gone that low for that period of time, it also tells me that it is at a, particularly because it kind of flattened out at the bottom, it tells me that the upside volatility is higher than a reduced level of volatility. So I would say, just my feeling about it is that the market is probably has more downside in it than upside at this point. Now this is interesting. I show you this every week. This is the Asbury 6 metrics. 6 indicators, mostly fundamental indicators of the from Asbury Research, and they are all positive, which you would expect given what I've told you. However, the trading volume is negative. So it tells you there is not enough enthusiasm to drive positive trading for the S&P 500 or for the broad market. So it is, again, more of a narrow market and indicating that I'm thinking technology in particular is starting to pull back a bit. So we've seen that in some of the other data. But it tells me that it's still mostly positive, but it still puts a little bit of a warning sign to me that be careful. Because when trading volume starts to decline, that is an indication that there is not enthusiasm in the market. This is the Asbury Research cross-asset relative performance chart showing the comparison of one class or one sector versus another. So you can see, and when they're in green, I show all three, going from left to right, the weekly, the monthly, and the quarterly. So all of it is still short-term. It's not long-term. The most short-term is the one on the left, which is the last week. So focusing on those that are all in green and showing there's enough strength to get a green box, stocks are more favorable than bonds. High beta, high volatility, is stronger than lower beta, low volatility. The broad market is stronger than the blue chips, the Dow Industrials, and technology is stronger than the broad market. Growth is stronger than value. The US is stronger than emerging markets and developed markets. In the bond area, corporate bonds are stronger than government bonds, and long-term bonds are stronger than short-term bonds. This is interesting. I don't remember seeing this, remember when I saw this last. This tells you, again, I'm looking for green boxes. It tells you that the US is very slightly higher than most other countries or regions. However, it also is not so strong that there is a trend toward the US or any other country compared to, the US compared to other countries, or other countries compared to the US. What it tells you is there is a lot of sideways pattern that may slightly favor the US or slightly favor another country. In other words, the US may slightly be better, but not much better than other countries. And there are some countries that are doing a little better than the US. Okay, gold, so playing off of what I showed you earlier, the spot price of gold as of last Friday was $1,926. There is no change from the week prior. So, and you saw that because the chart that showed gold had come down and then it kind of flatlined, and that is represented here by the fact that there's no change. However, when we went to that silver chart, you remember seeing that little tick up at the end. That tells you that there actually was a 1.7% increase in the spot price of silver from the week prior. The gold-silver ratio is 84-1, meaning gold is 84 times more expensive than silver. And what that does, as long as it's above 40, to me, it tells me that silver is a better value than gold. The monster box of silver, 500 silver bullion ounces of generic silver, is $12,540. The markup, the retail markup, is from my son, his price, is $2.23 over spot. That amount is shared between the retailer and the wholesaler. I won't say it's completely 50-50, but it's in that range, 50-50. And this makes a round of silver, when measured in a box of 500, $25.08, compared to when you do just one tube of 20, that's $25.58. So about 50 cents per round markup or additional cost when buying it in just one tube versus 500 rounds. I asked Preston, my son, I said, why is it that silver, the markup on silver has come down so far? And because you remember, if you watch this, that silver was well into the $4 range, and I think there was a time it hit over $5 per ounce. And of course, the spot price varies, but I was interested in why the markup has come so far down. And he said that in the summer, typically, not 100%, but most of the time, in the summer, there is less enthusiasm for buying precious metals. So the markup tends to come down. So if you're a buyer of silver, not a seller, but you're a buyer, the summertime would be a good time to think about accumulating, because right now the price has pulled back and the markup has pulled back. You can determine that for yourself, but what's a good time to buy if you want to buy? But I think there's probably a better value. We saw right now, we saw the monster box of silver go up above 14,000, and now it's down to 12,000. So just a thought. And I'm a fan of buying local and buying, from brick and mortar companies. So from everything I've shown you, you can see the the bulls are pretty happy. The bears haven't been, well, maybe they've been completely slaughtered or close to it. They're definitely taking a breather. Maybe they're a floor rug or something. But I think that, I'm going to say this because I try to stay away from predictions, but I will make a comment that I think there is more downside in the market, particularly in the next couple of quarters. For the rest of this year, I see, from everything I read and everything I evaluate, I would say the downside of the market is higher than the upside opportunity. But it has been nice to make money during the first half of this year. I will definitely say that, including the month of June. If you have questions or comments, leave them in the comment section below, and I will try to respond to them. Thank you for watching, and I hope you had a good 4th of July weekend. Thanks. Bye.